Business Finance, Chapter 13 and 14 examples. So we're going to look at examples from 13 and 14. In Chapter 13, we talk about capital structure of an organization, and in Chapter 14, we talk about dividend policy of organizations. We're going to start with capital structure. We have a company that currently has no debt. So they're a 100% equity company. They have information about their expected earnings before interest and taxes in normal economic conditions, and then they expect in a recession that will drop, and in a boom economy that will increase. And they're considering taking on some debt to repurchase shares of stock. So then they won't be 100% equity, they'll have debt and equity, and they want to know what the earnings per share changes would be if they take on debt. So first, we're going to calculate the earnings per share under each of the three economic scenarios before any debt is issued. So we have a recession. My keyboard is sticking. We have normal conditions. And then we have a boom economy. So in our recession, in our normal economy, we expect our income to be, or earnings before income and interest and taxes to be $14,300. We expect that to drop 35% in a recession. So we take our amount times 1 minus the 35%. In our normal, we expect the 14,300. And in a boom economy, we expect a growth of 20%. So we're going to take our 14,300 times 1 plus 20%. We have 0 interest payments because this has no debt. So our taxes are 21% of our expected EBIT. Our tax rate is 21%. So our net income is EBIT minus taxes. And earnings per share, of course, is net income divided by the number of shares outstanding. So net income divided by our shares outstanding of 7,500. So we can see that in a normal economic scenario, we expect earnings per share of $1.51, and then we have a drop in a recession and an increase in a boom economy. We want to know what the change is from each situation. So what is the change of a recession versus normal, and what is the change in a boom economy versus normal? So we take the EPS from the recession minus the normal and divide by the normal. In the normal, it's just normal minus normal divided by normal. And in a boom, it's the EPS from the boom scenario minus the normal scenario divided by the normal scenario. As you can see, because we don't have any interest expense, our change in earnings per share is exactly the same as our change in the earnings before interest and taxes. Now, what happens when we add debt? Okay, First, we want to know what our current share price is so we can determine how many shares we can repurchase with the debt we're going to take on. So our share price is the market value of our company, because we're 100% equity, that's 100% the equity value, divided by the number of shares outstanding. So our share price is $28.25. We are planning to issue $33,900 in debt to buy back shares at a price of $28.25. So we take debt divided by that share price, and we can buy back 1,200 shares. So we have our earnings before interest and taxes are the same under each situation. There's no change to that. But our net income will be different because now we're going to have interest payments. So our interest payments are the amount of the debt times the interest rate for debt. And then our taxes, which are the earnings minus our interest payment times the tax rate. So earnings minus interest times the tax rate. And our net income is EBIT minus interest and taxes. And then earnings per share, same. We take the net income divided by the number of shares outstanding, but we reduce the number of shares outstanding. So net income divided by our previous shares outstanding minus the number of shares that we repurchased. And let's carry that across. Okay. So now we have the earnings per share for the range from a recession economy to a boom economy. And we want to calculate the change in earnings per share. So recession minus normal divided by normal. And normal minus normal divided by normal. And boom minus normal divided by normal. So we get different now because we have interest impacting the amount of taxes that we pay. We see that our EPS, or earnings per share, changes more than just the change in our earnings from situation to situation. In this example, we're looking at two different capital structures. So our first structure is an all equity plan, or plan 1. And plan 2 is a levered plan, which means we plan to take on leverage, which is debt. So a levered plan is taking on debt. Under plan 1, we would have 320,000 shares of stock, and under plan 2, we would have 240,000 shares of stock and debt that we would pay 10% interest on. And we're going to look at these without taxes. So first, we're going to look at if our earnings before interest and taxes is 700,000, which plan results in the higher earnings per share. So under plan 1, we have our earnings before income and taxes of 700,000. And that's because if we aren't looking at tax effects and we have zero debt, we don't have any interest and taxes that affect our net income. In plan 2, we have an interest payment. So then we would take the 700,000 minus debt times the interest percent to get the amount of interest that we are going to subtract. So our earnings per share under each plan is our net income divided by the shares outstanding. So in plan 1, we have 320,000 shares outstanding. In plan 2, we have 240,000 shares outstanding. Okay, so plan 1 has the higher EPS when the earnings is 700,000. Next, we're going to look at what if our earnings was 950,000? Is plan 1 or plan 2 going to have the highest earnings? So net income is 950,000 in plan 1 where we don't have interest, and in plan 2 it's 950,000 minus the interest payment, which is debt times the interest rate. So then our earnings per share, we have 950,000 divided by 320,000 shares, or 722,800 divided by 240,000 shares. So plan 2 has the higher EPS in that situation. So under A, the all equity provides the highest EPS, and under B, the equity and debt combination gives us the highest EPS or earnings per share. Now, what is the break even EBIT? So this is where at what income would they have exactly the same earnings per share, either plan? So at what net income would they have the same exact result? Okay, so this is, we take plan 1 shares, so 320,000 shares, times the debt, times the interest rate, and then we divide by the difference between plan 1 shares outstanding and plan 2's shares outstanding. So at $908,800 net income, either plan would give us exactly the same earnings per share.